I'm going to tell you a quick story so you can understand why tax planning is so important for an early retirement. Now, I have to take a big step back to do this, and I think it's going to really make you understand why exactly tax planning is crucial if you want to retire early and not pay any more than you need to. Most people think of tax preparation, which is simply here's what's happened in the past, and CPAs are very valuable for that, but oftentimes it's less forward looking. And that's the big difference here. So I'm not simply saying here's what's happened in the past. I'm saying here's what we're going to do in the future to minimize your lifetime tax bill, not just in a single year. So here's my story. Many of you know this already, so apologies if you've heard it, but if you don't, I think you're going to be in for a treat. So here's my story. I worked at the very fancy Beverly Hills firm with the lights and the parking, and I hated it. Although most people had no idea why I hated it, the truth is I just didn't fit well with the company culture. Why am I telling you this? I'm telling you this because when I was there, I was learning how to create tax-free income in retirement. I was working at a firm called Nuveen, and Nuveen is one of the largest municipal bond shops in the world. And so they specifically work with creating tax-free income. And so I was learning all the tips and strategies to do just that, but it had nothing to do with retirement planning. So I had this idea, when people retire early, doesn't their income drop and it gets really low, sometimes zero, and aren't there opportunities there? So I went to my manager at the time and he said, hey, here's an idea I have. That's pretty much it. What do you think? And they pretty much said, don't worry about it. They said it meaner than that, but they pretty much said, don't worry about it. And I kind of thought they were right, meaning I didn't really know if there was validity to my thinking here. So I started a podcast and it wasn't called Early Retirement. At the beginning, had the worst name ever. Personal Finance Redefined. That's a mouthful. And then over time, I started to go, you know what? Early retirement, that's what everyone's asking about. So I specifically started doing content for that. And that's how the Early Retirement podcast continued to grow and this channel. And so essentially what I realized is when people retire, their income gets really low. They have an opportunity and they can say, I want to keep my income really low. This is awesome. I pay taxes for so many years. I can't wait to no longer have to pay any taxes or very little in taxes. Or I could say, can I be strategic during my tax planning window? And so every single week I would do podcast episodes where almost no one was listening, but a few people. And in the first year, I got 1,000 downloads. I went 1,000 people. I helped 1,000 people feel more confident about their early retirement. The next year, 10,000. Now we're looking at 40, 50,000 downloads a month. And that's all because I see there is a real surge and people going, I don't want to work forever. I don't believe in that traditional retirement of 65 to 95. What can I do to put myself in the best position possible? Now, my partner used to joke all the time and say, why are you talking to the wall every Monday? Because that's pretty much what I was doing. Now, all of you guys are saying this is helpful and oh my gosh, yes, I want more of this. So whatever you guys want, that's why I do this channel. This is for you, not for me. I just love doing it. So let me know in the comments what you want more of. To finish the story here, the idea is one day your income is going to be very low and you have an opportunity to once again say, I'm so glad this is awesome, or I want to be proactive here. What can I do? And I'm going to show you an example right now of why tax planning can be so crucial and how it can in fact lead to paying 0% in taxes if you're doing the right strategy. So I know a little bit of a longer story to begin. Now I love what I do for my life. I get to help all of you guys retire early with total confidence, and that's my goal. Once again, I don't love tax strategy for tax sake. I love the idea that if you are good with numbers, you can retire 6 months, 2 years, 5 years earlier, and maybe you have more time with your mom or with your father or with your spouse. And good luck quantifying that on your health. You just can't. You can't put it on a spreadsheet. So let's hop right in so you guys can now see how I quantifiably come up with these results. Let's do it. This is a tax report for my client, and this is a sample. And I want you all to see this because I think it's going to apply to a lot of you. So this is Joe and Sally's sample for 2023, and here was their income, and this is going to surprise you. And so I'll make sure you guys can follow along here. 97,500, that was their income, and that was their adjusted gross income. Sometimes these are slightly different. In this case, it was the same. Their deductions, you can see here, 30,700. So they took the standard deduction, and then they had taxable income of 66,800, meaning this was the income that was taxable, not their total income. And then here's their total tax, $0. And so people go, wait a second, how do you have so much income in $0? Well, what was happening is they weren't actually living off of their IRA. Many of you are retiring early, let's call it at age 57 or 56, and you're going, hey, I've got this brokerage account, and I nickname it the superhero in my podcast if you haven't heard it, because it's the superhero. It's what lets keep your income very, very low. And so some people look at this and go, this is amazing. I did it. I'm able to live off my brokerage account and I keep my income really low. Yeah, I pay a little bit in capital gains, but I think I pay, what is it now? 15%, maybe 20%. I say, no, maybe you can pay 0%, because some of you are looking right now and you go, wait a second, that says 97,000 of total income. How is this $22,000? How is there zero taxes? What am I missing here? And so here in the US, we have a marginal tax rate system, which means on the first $22,000, whether it's you or me or Bill Gates, we pay 10%. On the next 22,000 to 89,450, you pay 12%, and so on. And so what we're going to go down here is, I want you to look at this right here. This is a completely different schedule that a lot of people don't know about. This is what's called your capital gains schedule, which is different than ordinary income. And so what you're seeing here is this couple, where I'm taking this data from, is they want to have $30,000. That's what they need. And they're taking that from their IRA. And when they take it from their IRA, it increases their income. So it's as if you just made more money. At the same time, this couple has a very significant Apple stock position, and they are selling that on purpose to pay 0% in taxes. How is that possible? As long as your income is below $89,250, you pay 0% in taxes. So let's take a hypothetical. Let's assume you bought Apple stock for $10,000. Keep it really simple. And let's assume it grew to $100,000. That's a $90,000 gain. Some people just equate that in their head. Yep, I'm going to have to pay 15% in taxes, when in reality, you don't. If you retire and your income is very, very low, what you're able to do is say, okay, I bought Apple stock for $10,000. It grew to $100,000. There's a $90,000 gain there. I'm going to have to pay taxes on it. And assuming your income is zero, you have a $90,000 gain, the first $89,250 gets taxed at 0%. And then from $90,000 to $89,250, there's a $750 difference there. That would get taxed at 15%. So in this specific example, for a client of mine, we went in and we just sold enough stock so they could live comfortably, and they didn't pay any taxes on it. So it's almost like it acted like a Roth IRA for them, where it grew and grew and grew. You could access it penalty-free before 59 and a half, and we paid 0% in taxes, almost like tax-free compound growth. So this is a really, really special thing to be aware of. If you're retiring early, you have the potential to pay 0% in taxes. Now, I'm going to show you one more example of this so it can fully make sense in your head. Sometimes different visuals work with different people. By the way, I showed this exact example to a client of mine before going through their specific case, and they went, oh my gosh, this is awesome, but what about Roth conversions? Like, how does that impact this? And I said, wonderful question. And I'll ask someone who reaches out, I'll say, what are you prioritizing? Is it tax gain harvesting or is it Roth conversions? And they'll go, first of all, I'm just trying to learn these subjects. But now that I'm starting to get the hang of things, I see your point, because here's what is happening. When you do that tax gain harvesting I just showed you, if you bought a Apple stock position, it's grown a lot in value, you can certainly pay 0% taxes on it. But now you don't want to do the same amount in Roth conversions. Why? Roth conversions increase your income. And so what's happening is it's as if you just made more money. So now you might essentially be limiting the effectiveness of those conversions if you did all of this sale of stock and all of these Roth conversions. So what you want to do is, it completely depends on your specific situation and dictate it based on the timing. For example, one client came to me and they were 63, and it made sense for them because they had a really significant stock position to do tax gain harvesting for 2 years. Medicare kicked in. Subsidies were no longer of importance to them. Then we're going to do Roth conversions from 65 until 68, which is when they were collecting Social Security, then dropping down Roth conversions a little bit. But the whole time you're staying dynamic, because if markets go down significantly, those Roth conversions, can become a whole lot more valuable. Think about it like this. Let's assume you bought Apple stock for $5 and it grows to $10 and it's all in your IRA. It's as if you just made more money. You just have to pay taxes on it, as if, once again, you made more money. Pretty simple. But what if you bought Apple stock for $5 and it went down in value? Now it's only worth $1. What if you did a Roth conversion when it's worth $1 and then it grows to 10? Well, now if the difference from 1 to 10, that's all tax-free. So some people go, well, I've got it in my head. I've got my married strategy. I'm going to do a Roth conversion from 61 to 64, and then from 64 to 67, I'm going to, do tax harvesting. And they've kind of got this brilliant plan. And then all of a sudden markets move. And they're like, what do I do now? And then all of a sudden tax law changes, which, by the way, tax law is changing in 2026. And so it's like, hey, now there's almost I've got this little bit of, I know enough to be dangerous. That's what most people say when they reach out. People are not reaching out to me going, what is this stuff? They're going, hey, I just don't know the most optimal way to do it. And I'm happy to pay if I can see significant value. So I always break it down into SB or IB. Some people reach out and there's significant value. I mean, there's a significant reason to work with us. We can add significant value in excess of our fee. Other times there's IB, which is incremental value, or IV in this example. I'll call it incremental bang for your buck or significant bang for your buck. I try to keep it fun. But the idea here is very simple. You want to make sure you're doing whatever's going to put most dollars in your pocket over time, whether it's tax gain harvesting or Roth conversions. It just depends on your specific strategy. Depends if you have a concentrated stock position. It depends specifically if RMDs are going to be a big issue. Some people come to me and they're like, oh my God, I'm going to get crushed by RMDs later. I go, why don't you spend more? And they're like, what do you mean? I don't need to spend more. I go, well, if you don't need to spend more, don't just go spend for the sake of spending. But what many people overlook is the idea that you might want to spend more while you have your energy and health. And yeah, there's still going to be RMDs. You're still going to be doing conversions. It's just a whole lot less. And if that means you enjoy your life more, many people don't think about that. They're only thinking about the true on paper financial optimization, which isn't bad. But if you get too locked into the numbers, you actually sacrifice what I find are adventures along the way. And I don't want that to be the case either. Let's still hop in because I've got something fun to show you. I personally like when things are quantified for me, just so I can see the exact values of why I'm doing some strategy over another. I think all of you do as well. But if not, you might want to tune out now because we're going to have some fun. So if you're not looking for retirement tax fun, then certainly stop watching. Now, of course, I think you're going to find value from this, but I'm telling you this before I kind of show you my tax bombs in kind of scenario here, because I want you excited for our meetings. If our clients are like, oh, here we go again, boring financial guy going over numbers and like, we don't subscribe to that. We subscribe to, hey, how much can you spend in retirement? Here's the tax strategy to minimize. Like, we want you over the moon to meet with us, not, oh, here we go. We don't do that. So want you equally excited. So let's go down here and show you the example I just went through, just in a little bit of a, not uglier way, but this is how the real sauce is made, if you will. So I have no issue sharing all of this. I use a million different softwares depending on what I want to show a client. So this here is a sample. So for 2023, that same person I just showed you, they were taking $30,000, so that from their IRA, but they weren't working. So no wages, no interest, no dividends, no Roth conversions, no pension, no Social Security, all zero. But they did have long-term capital gains of $67,000. So that's what we were selling to pay 0% in taxes. Now let's fast forward to the future. In the future, my client might be 85 years old one day, and hopefully they're still doing what they want to do, which is hiking and river rafting and all the fun stuff they want to do. In the future, they might be forced to take out $150,000 a year. And so you're going, where are you coming up with that? Well, some of you are going to save and invest really well, where in the future, you're going to have a required minimum distribution where you have to take this out whether you want to or not. And then you might have a pension. So a spouse might have a pension. This particular couple, they do have a pension. It's just not on right now. So I'm including that in here. And then they're going to have Social Security as well. So if we add up all of this and we go way into the future, what's going to happen here? I'll run a report and I'll show my client this exact scenario. I go, congrats, you're going to have $350,000 of income. And they're like, whoa, have you heard like nothing we've talked about? I don't need $350,000. I go, oh, I know. The government doesn't care. And so you're going to get taxed up the wazoo. Okay, that's me putting it nicely, up the wazoo. And so 28% is going to be their bracket, which means any additional dollar that they take from their IRA is going to get taxed at a very high rate. And God forbid something happens to them, their kids are going to get taxed at a really high rate if they're in a healthy tax bracket. So between federal and state, you could be at 40% taxes. And so they're like, oh my God, help me not do this. And that's where we show tax gain harvesting or Roth conversion. So for Roth conversions, what I could tell a client is I could say, instead of maybe selling, a bunch of stock, let's not do that at all. Let's keep your income really, really low and let's do a Roth conversion. And I'll show them if we did a $40,000 Roth conversion. And by the way, I'm making this really, really simple. It's not as simple as I'm kind of showing it to you, but I'm just showing if you did a $40,000 Roth conversion, it's going to cost you about $4,200 in taxes. And so some people go, I can't get my head around this. You're asking me to pay taxes when I don't need to. And I go, that's true. It's so that you don't have to pay taxes in the future. Many of you have heard my cauliflower example, but I'm asking you to eat a little bit of cauliflower to avoid having to eat a lot of cauliflower in the future, even when you're full. And that's what RMDs are going to be like. So they're like, help me understand it. Okay, I know why you want me to do it, but really, can you harp home on this? I go, I'm happy to. What I'm essentially doing is I'm saying, what if we didn't do Roth conversions? What would that same $40,000 cost you in the future if you put out the money? And I'll show a client and I'll say, I showed you before it's about $4,000. Now it's about $12,000 on those same $40,000 that you were going to take out anyway. Now you're going to be forced to take them out. They go, oh my God, Ari, I see it. $4,000 versus $12,000. You're saving me $8,000 in taxes. I go, yes, but don't do a Roth conversion. They're like, now they're mad at me. They're like, I want to do it. Like, look at this. This is clear as day. I can see the cost, 11,962 versus before you were showing me about 4,200. I go, that's not why we're doing it. That's one reason. The major reason is all of the growth from right now, 2023 or 2024, of course, now 2024, and we should have to make sure all of this is being reflected appropriately until their tax bomb, which is going to happen in 2030. All of the growth is tax-free forever. So as it's compounding, you're adding potentially hundreds of thousands of dollars tax-free, and you're getting these tax savings. So what you want to do is really quantify what's going to put more money in your pocket. Is it tax gain harvesting that I showed you before, or is it doing Roth conversion? So hopefully this was helpful and you did not fall asleep. Put it simply, I love tax planning because it's not simply what happened in the past. It's a forward-looking outlook on how you can retire early with total confidence, not paying any more than you need to. So very, very, very simply, when someone once came to me and said, hey, why do you love this stuff? I go, if you're good with numbers, you can retire earlier. And you can't quantify that on a spreadsheet. And that's what I care about. I want you to retire early and spend more time doing what you want to do. All of our time is precious here, and you can choose how you want to spend it. And if you're good with numbers and you can see there's significant value through doing planning and it makes sense for your situation, why not do this? Why not consider strategies to pay 0% in taxes or Roth conversions to minimize future RMDs from estate planning perspective, from a tax planning perspective? There's so much value through utilizing these strategies. So if you're looking for a custom strategy, or you don't want to make a mistake, or you want a partner to help you through this for the next 20 plus years, that's why we exist. We are here to help you navigate all aspects of this. Now, some people like yourselves, not all of you, are going, hey, I want to read tax law in retirement. This is what I want to do. Other people go, I do not want to do this. That's why I'm trying to hire someone. And that's where we come in. Now, we do take a holistic approach. So if you're watching this video going, hey, I just kind of want one-time plan on tax planning, or that is not what we do. We used to offer similar models on like a one-off basis, but we found people didn't implement it, or they implement it incorrectly. So we no longer offer that model. The only way we work with clients is on an ongoing basis, as that's how we can add significant value. That's where we feel it makes sense for that partnership. And so it's Root Financial Partners for a reason. It's a partnership. Now, if you're wondering when you reach out who you're going to speak to, it's me. I take the first call with every single person that reaches out to determine if we can add significant value for you, or if it's just that incremental value. And if it's not significant, I'll recommend you don't work with us, or I'll point you in the right direction. We do limit the number of clients that come on every single month. So some people reach out and we wouldn't actually begin planning for a week. Other times it's a few months. So you can go through our screening process in the description below, and you can apply to work with us and take the next steps to get really clear on your optimal retirement. Hopefully this was helpful. Love you guys.